My name is Michael Guy, publisher of the Lead Lag Report. Joining me have Danielle DiMartino Booth and Joseph Wang. I want to have each of you introduce yourselves briefly for those who are not familiar with who you are and your background. So we'll start off with you, Danielle.
So I started off at a firm that's no longer with us called Donaldson, Lufkin and Jenrette. It was sold out to Credit Suisse at the height of the dot-com boom for billions of dollars of losses, believe it or not. When I left after 9/11, I thought I was retiring, but I ended up having a very short stint at the Dallas Morning News, which got me an audience with Warren Buffett and eventually Richard Fisher. I advised him for the better part of 9 years until he retired, and I retired right behind him. And now I've got an independent research boutique that's been up and running called QI Research since 2015. We've got both institutional and very highly educated retail clients.
In other words, if you are not subscribed to Danielle's research, you're not educated. And I'm joking about that, but I do encourage everybody to take a look at Danielle's work. I've seen it myself. It's quite strong. Joseph, go ahead.
Well, first of all, thanks so much for inviting me. It's a pleasure to be here with Danielle and yourself. My name is Joseph. I write a blog, fedguy.com, where I teach and write about the markets. Before I started my blog, I was a senior trader on the Fed's trading desk. And so my job there was to basically study what happened in the financial system. And that's how I approach everything that I do. So I think about what the Fed is doing, think about how the world works, think about what the financial system is. Yeah, pretty much it. Also, I have a book, centralbanking101.com, and also I have online courses to help people understand how the markets work.
So I'll start with you, Danielle. I put out a meme, and I've had this theme out there before, that the Fed doesn't own the bond market, it owns the Fed. The Fed follows ultimately what the bond market is doing. I'm curious to hear your thoughts on what the hell is the Fed thinking, given what seems like now a lot of stress points that are taking place because of the long and variable lags, which I'd argue the Treasury market is now starting to get nervous about.
Well, so I would push back a little bit in the sense that, well, rephrase, since Volcker, the Fed has largely been owned by the bond market since January of 2022. In the spirit of football season being upon us, Jay Powell's done a lot of giving the bond market the Heisman. He's extremely methodical about it. He's a lawyer by training, and I call him my Obi-Wan, because if the market doesn't see where his head is, or Christopher Waller, his chief lieutenant, he just kind of talks them through it until they come to a meeting of the minds. Of course, nothing systemic has gone wrong, right? Since late 2018. So Powell's had a little bit of latitude in the sense that nothing has, quote unquote, broken yet. For us to be in the middle of the briskest bankruptcy cycle since the great financial crisis, and for nothing to have broken nearly 2 years into this terror campaign of his, is pretty remarkable, I would say.
Okay, there's a lot to actually unpack there, but sure. The reason Powell was giving the middle finger to the yield curve is because credit spreads have not widened, right? I've made that argument many times before. The Fed doesn't care about the S&P. They care about blowing out of credit spreads, which you are not seeing when you look at junk debt relative to AAA. Obviously, you're seeing it when it comes to the real economy, to your point on bankruptcies. Have you done any work on the historical lags in terms of when the public credit spread side of things starts to respond to private bankruptcies? Because that's one of the big disconnects that I think is really underappreciated.
So I think that what we need to understand here is not that it's different this time. It's that the structure of the fixed income markets have inherently changed. Big broker dealers used to hold large inventories of corporate bonds all the way up and down the credit stack. That is no longer the case, thanks to regulations. In my eye, short-sighted regulations. On top of that, we have the $1 trillion plus fixed income exchange traded fund universe. So what we see in spreads today is not what we saw in spreads in prior cycles. What we see in spreads today are a handful of mostly liquid energy names that trade upon inflows and redemptions from these massive fixed income ETFs. What does not trade, that really dictates what spreads should be, and it's largely invisible. And that's why I have followed the markets that the Fed has broken, and they're the securitization market. And they give a much better reflection of where credit actually is vis-a-vis whether you're talking about a high yield spread or an investment grade spread. Because again, we didn't have the $1 trillion ETF fixed income universe 13 years ago.
Joe, I think that's actually maybe a good transition to you. I've seen some interesting studies that show there's a pretty clear link between narrowing of credit spreads and a weaker dollar, which obviously it's the opposite now, right? As the dollar is reaccelerating, and as I've seen, looks like you're bullish on the dollar continuing its relative appreciation. How do you think about currency movement here against the backdrop of not just inflation, but now oil showing some signs of life again?
Yeah, of course. Well, first off, I'm going to push back against the idea that the bond market controls the Fed. I'm pretty sure that the Fed controls the bond market. And more generally, I think that today central banks own the bond market. A good example of this is what we would see in Japan, where the Bank of Japan just says the 10-year yield shall not pass, and it stays there. So we have a lot more tools today than we did in the past. So that really gives central banks a lot more power in controlling. So another example you can see is that over the past few years, or past couple years, the Fed has been telling everyone that they're going to stay higher for longer. And all along that journey, the bond market fought it and was completely and 100% wrong. So what the bond market will do, I think, is largely strongly influenced by the Fed on the short and medium tenors. But if you go out longer dated, less control, but maybe not yet. So we can see that they have tools to do that. Now, to your question about the dollar, I think what we're seeing right now is really how monetary policy interacts with financial system and influences the real economy. Let me explain. So when we think about what the central banks are trying to do globally is that they're trying to tamp down on inflation, right? So they're all raising rates. But the way the financial system is structured in each country is very different. In the US, for example, as we all know, people here have 30-year long-dated mortgage rates. So when you raise interest rates, it doesn't have as big an impact. We also have very deep and liquid capital markets. So even though the banking system maybe contracts a bit, maybe doesn't offer as much credit because of higher interest rates, the capital markets can more than make up for it. But you don't really have the same thing going on in other countries, say Eurozone, say Canada, say the UK. And so when they raise rates, it's a lot more effective in slowing down the economy than it is in the US. So what I'm thinking is that as on the way up, the Fed was basically leading among the developed world in hiking rates, and we saw the dollar slowly significantly outperform last year. So as we are reaching our terminal point, and many central banks are thinking about cutting rates in the future, I think the Fed will be the last to cut. And so I see that short-term interest rate differential widening again in the dollar's favor. I think we're at the beginning of this, but I think that this is going to lead to substantial dollar strength in the coming months.
Joseph, I'm going to interject here. I'd love to ask a question about the persistence of the inversion of the yield curve and how that plays into the idea of the Fed standing its ground and holding the line on higher for longer. What are your thoughts there?
I don't think the inverted yield curve gives any economic signal. I mean, I think that we've really moved away from that world where a bond market is largely traded among private actors. We're in a world where the government has a really heavy involvement in the bond market. You can see it in yield curve control in Japan. You can see it in QE in the US. Of course, they have trillions on the balance sheet still. You can see it in all the regulations that the government puts out in an attempt to make the system safer, but it also creates tremendous demand for Treasury securities. We see that with the banks, for example. They have to, they're strongly encouraged to hold Treasuries. So all that has to be taken into account when you're looking at the shape of the curve. Now, one thing I will say, though,
I was actually asking if it reflected Fed policy, not the economy, and I think we agree there.
I think it will. I think it will. So because of this distortion we agree on, I think in time it will have a better inflection policy because the Fed, from my read right now, is thinking about allowing QT to continue even as it cuts rates maybe next year. And so I think what's going to happen is that there's going to be less of a distortion going forward, and maybe that we have more of a reflection on policy, at the stance of policy. Right now, I think there's a lot of distortion. So on the long end, it's not fully reflected.
Michael, can I jump in there for a second and kind of unpack extremely briefly what he's talking about with the continuation of quantitative tightening?
And it is your show, but both of you. And I will say, I think this is actually really interesting because the part of this actually, this discussion is I want to get to the risks of a tail event, because just going with Joseph's point about the dollar keeps on rising, at some point that's going to be a real strain on emerging markets that create potentially a global ripple, right? That could have all kinds of implications and then force the Fed to then respond to the bond market, which then presumably has a flight to safety moment. But anyway, sorry.
Actually, Joseph would know better than I would know, but Lori Logan is a lifetime Federal Reserve economist. She was at the New York Fed. She's now she's now the president of the Dallas Federal Reserve. And she came out, she floated a plan a few months ago now that basically posited that come 2024, when the Fed is theoretically, when the unemployment rate continues to rise, ready to start lowering the Fed funds rate, that it'd be able to do so but to continue, as the New York Fed put a study out a few months ago, but to continue shrinking its balance sheet. Now, I take Logan's theory one step further, which Powell has advocated for at the podium. His most recent FOMC press conference, he advocated for the Logan plan going into 2024. I even suggest that towards 2024 into 2025, if the Fed was still continuing to roll treasuries off its balance sheet, as the Fed funds rate came down and mortgage prepayments increased, the Fed could start playing catch up on the mortgage-backed securities that it has not been able to roll off of its balance sheet because mortgage prepayments are so slow. But we are $1 trillion into the shrinking of the Fed's balance sheet as of the latest week's data.
I think Danielle makes a really good point about the mortgage-backed securities. So the Fed has a longer-term plan of having a Treasury-only portfolio. So going forward, no matter what the plans for QT are, I think their inclination is to just run down that mortgage-backed security portfolio. And maybe if there's a stop to QT, they're going to reinvest that into treasuries. So going forward, I think that is a structural change that is worth highlighting.
Okay. So all that's happening against what I suspect, and I want to hear both of your thoughts on this, suspect would be a stress point in terms of just refinancing risk next year and the year after. So you've got a lot of corporate loans that are refinancing next year, the year after. You've got a large amount of treasuries that need to be refinanced on the government expenditure side. I think Lisa Brahman would put a stat out, 31% of all U.S. government debt outstanding, roughly 7.6 trillion will mature over the next year. And presumably that, need to be rolled over into higher rates or going to be rolled over into higher rates. Danielle, in terms of what the Fed looks at, and I'm sure they've got all kinds of models around this, do they factor in at all sort of the timing of rollovers of big swaths of debt for the path of interest rates, or does that not come into the picture at all?
Well, I think it does. The New York Fed does follow extremely closely. And I'm going to answer your question in a sideways fashion. It's not so much that they're paying close attention to refinancing or the wall of maturity, as we like to call it, but they pay very close attention to issuance and or when issuance stops. And that is something that typically flashes systemic risk. We saw that in late 2018 when there were no high yield bonds issued for 41 record days after Moody's downgraded the debt of General Electric. So it's always going to be a holistic credit market event that is going to get the Fed's attention. So if, as we have seen, there hasn't been we've seen a ton of commercial real estate mature in 2023. But there's nothing really bad that's broken out. I mean, except for, office buildings trading at 33 cents on the dollar. If you call that bad, I guess that's bad if you're on the opposite end of that recovery rate, right? And we are seeing recovery rates on collateralized loan obligations lower than they were already during the great financial crisis. But as far as what the Fed pays attention to, I think it really is whether there is issuance in the market. And we saw coming out of Labor Day that there was a rush into the markets to sell fresh debt. As long as that continues, you can let that bankruptcy cycle continue along its merry way.
Joseph, I'm curious, given your time at the Fed, there's the narrative that's always out there that the Fed cares about the market, in quotes, the market. And I'm saying in quotes because there's more than one market. I think most people think of the market as the S&P, as the NASDAQ. The market should really be all stocks, all risk-on assets. Look at small caps. Those don't look like they're in a new bull market. Certainly, international does not look like it's in a new bull market. Does the Fed at all care about stock market movement outside of the headline averages when it factors in wealth effect dynamics, inflation, and consumer spending?
I would think about it from another perspective. Think about who the people in the Fed are. They are mostly people who are spent their lives working at the Fed, whose retirement is largely in some kind of target date fund that's heavily invested in the S&P. So I would think that if they're watching that their retirement dreams slowly fade away, I think that has to have some impact in how they think about things. But whether or not they would admit that, I don't know. But,
Or every member of the Fed has a private, an old-fashioned pension plan. I'm going to get money when I'm like 60-something years old. I have no idea from the Fed. And they have a 401k, and they have matching, and they have platinum-plated healthcare benefits. So they're very much bureaucrats, to Joseph's point.
And 5-week vacation and 6 weeks if you've been there really long enough. It's a really cushy place, guys. So, but to your point, Michael, yeah, I definitely think that Fed cares about the stock market. I mean, think back to the time of Bernanke, right? The policy back then was to engender a wealth effect, make everyone have more money to feel wealthy, have more money to spend. I think so. So that plays in many different ways. And of course, there's a financial stability angle as well. But I'm going to push back a little bit against the idea of some kind of financial distress going forward. So you're totally right that, the next 2 years, we're going to have a wall of maturity. It's going to be staggered, of course, where corporations will have to refinance their debt at higher rates than they took out that debt. But I think we also have to look on the asset and income side as well. If you look at corporate profits, for example, the chart just basically skyrocketed post 2020, in part because revenues went up with inflation, and they also locked in lots of low interest. So in the event that they have to refinance at higher interest rates, you have to keep in mind that they have a lot of profits. So maybe that just kind of normalizes to how things were before 2020. So they can definitely afford that. And the second thing I would highlight is that, broadly speaking, the way the economy works today, it's just a lot less interest rate sensitive. Now, if you look at aggregate data, interest expense for the non-financial corporate sector is just not a big part of the overall picture. So one way you can think about this is that our economy is not so much, say, manufacturing or driven. It's more services driven, and you just don't need to have the same expenditures, big capital projects that you did in the past. And you see this happening in the Eurozone as well. So yes, there are going to be a lot of people who have to renew. And I think it could be more sensitive on certain sectors. I think Danielle rightly mentioned that, if you are a big commercial real estate investor, well, you're kind of in the game of borrowing short and lending long, to some extent. So you're going to feel that, but I don't think that's representative of industry in general.
Yeah, and just to be clear, the reason I was asking the question about and trying to distinguish between the S&P as the market and then everything else is, if you believe in quotes the market, whichever market you're looking at, is a discounting mechanism of the future, that there's a signaling effect there. It's a real question mark in my mind as to this narrative that the consumer is strong, there's demand pull inflation, that the economy is rip-roaring. Meanwhile, you look at the performance of retailers, XRT as a proxy, an ETF, equal weight across all kinds of retailer stocks. It's basically back to May of 2022 levels. Doesn't look like a new bull market whatsoever. So if a lot of this is predicated on the idea that the economy is strong because you're still out there spending, I don't understand why the stock side has not responded. And if that's the case, if that is a disconnect and the Fed's ignoring it, that to me could be actually a really big missed data point, if that makes sense.
Oh, okay. I'm going to jump in here. The corporate sector is not as interest rate sensitive at the moment. The household sector, when we got the recent revisions to the GDP data, we saw that the household sector is now devoting 2.5% of disposable income to interest service. And it looks to be headed to 3%, which would break through the records going into two very nasty recessions if we hit that 3% threshold. So in that sense, and you are seeing it in retail, you're definitely hearing it in earnings reports. You'll see more of it as people who make $100,000 or more begin to repay their student loans, the people who are not eligible for the relief plan. So I think that is where this coming year, at least, you will see rate cuts come into play. But to Joseph's point, corporations, they really do have a little bit more rope to hang themselves with. But you get really tenuous in 2024 when your top line aggregate for the S&P 500 starts to see a negative number in front of it. And if and when, again, I go back to the credit market closing in terms of bond sales, that's when you get the feedback mechanism from 70% of the US economy being consumption, hitting a wall and feeding back into the corporate credit markets. So it's not so much that the functionality of the markets is questionable. It's that you could have the consumer and a weakening consumer feed into the credit market and thereby feed into corporations' wherewithal to sell debt.
Since we're talking about the consumer, I want to get both of your thoughts on the narrative that the consumer is strong. Again, I have my doubts given the performance of consumer sensitive stocks outside of Amazon, obviously. But, and although now who knows with Apple, how that's going to play out with China. But from the data that you've looked at, Danielle, is this sort of standard type of, consumer strength in quotes, or are there cracks beneath the surface that the headlines are not really uncovering?
So I think that we're having a very hard time assessing the consumer And again, I direct messaged you before I came on. I'm not up at 2:00 in the morning with the tinfoil hat on. I promise you, Michael.
I am, and that's why I'm constantly posting all kinds of expletives on X. But anyway, sorry.
Well, so take this morning's initial jobless claims data. It's only missing 24% of the population. So, but the financial media is going bananas over jobless claims hitting the lowest since since February of 2023, since February of this year. But again, California is 22.4% alone in the last 12 months. You add the 4 states up together that did not submit claims data in a holiday week, and you get to 24% of the U.S. population. It's a big number. Last September 2022, there were exactly 0 states in the United States, including D.C., with rising continuing jobless claims. Now you've got 47 with rising continuing jobless claims. In other words, you know somebody who's lost their job. It's no longer 6 degrees of separation like it was, say, at Christmas time. Now it's like 2 degrees of separation. So, and we've seen, whether you're talking about Discover Financial, Ally parking money at the Federal Home Loan Bank, Signature, you've heard all the CEOs of lenders say that the delinquency situation is no longer contained, to borrow a Bernanke term, to subprime. And that they're seeing, quote unquote, and this is a code word that everybody should be paying attention to on earnings calls. When a lender says that they're seeing normalization in household default patterns, that means that it's climbing up the FICO ladder past subprime. And that's exactly what we're seeing. And it's why I'm watching people who make $100,000 or more, who are responsible for 22.5% of U.S. consumption, who bought a house in the exurbs, didn't know what property taxes were until they got their first bill, have a $1,000 BMW car payment, and now they're going to have to start paying their student loans back. That's what you call normalization in the household sector, when it's beyond the subprime borrower who's getting hit hard.
So I'm more positive on the consumer and the economy. So the way that I would approach this would be just from top down. What's the economy doing? Are we growing? Well, if you think that the potential growth rate so if you think the stable growth rate of the economy is like 1.8%, which is what the Fed thinks. Well, in the first quarter, we grew at 2%. Second quarter, we grew at 2%. Third quarter, we don't have the data yet, but nowcasting suggests there's some acceleration there. So we're growing above trend, right? That's really good. Now we look at unemployment data, unemployment really low, right? Multi-decade loans, and wages continue to rise, 4 or 5%. So all in all, if you look at the big picture, things seem to be going pretty well. And, on the aggregate, most recent consumer spending data seems fine as well. So, for me, I don't really see any doom and gloom, but I think it's really important that we take note that there are some places where it seems to be some concerning. Like Danielle rightly noted, if you look at delinquencies for credit cards, for example, that seems to be ticking up, and for auto loans as well. So that's something we want to keep an eye on. But on the big structure, things seem fine to me. Now, I will also, so Michael, to your point about looking at the stock market, these consumer sensitive companies. Now, I think that adage, the market is not the economy, is really accurate. I mean, stocks go up and down for all sorts of reasons, right? I mean, maybe something happened in some macro event somewhere else. Rates are going higher, for example, right? So people sell stock or they sell indexes that contain these stocks. And you also have options activities and so forth. And if you just recall, I mean, over the past couple of years, we've seen a lot of bizarre behavior in individual single stocks simply because, let's say, people play options and whatnot. So I don't read fundamental economic data from movements in stock prices. I don't think that's how the stock market works from my perspective.
So, Michael, if I could just throw one thing in there from my Fed mentor, who was a 40-year veteran and the director of research at the Dallas Fed when I left, he taught me that if you want to look for inflection points when top-line GDP data is telling you one thing and the jobless data is telling you another thing, always look to revisions. So rather than scream to the mountains about the birth-death adjustment, we've been following the revisions very closely. And my mentor's rule of thumb was once you get 3 positive revisions to non-farm payrolls in a row, that you're an inflection point. The economy is getting ready to turn to expansion. By the same token, once you get to 3 downward revisions for non-farm payrolls, you've hit an inflection point. And we now have had 7 in a row. And we went back and looked at post-war data in our most recent daily after that non-farm payroll data hit. And by the time you see 7 revisions, you're typically coming out of a recession. I want you to stop and listen to that one more time. But by the time you get to 7 downward revisions, you're typically exiting recession.
Wait. When was the last time that happened? That kind of streak of downward revisions, the last cycle?
Oh gosh, I'd have to look back, but I believe it was, these were only seen in the double dipped recession of 1980. And then there was one 6 months later, 81. And then going into the great financial crisis. 7 downward revisions, 7 sequential months in a row.
Danielle, you're referring to the farm payrolls, right?
Yes, I'm just referring to the persistence of downward revision.
Right. I think that's definitely worth noting. And I think that is definitely concerning. But I would offer another perspective, which may or may not be true, but I think it's worth thinking about. So over the past, hundreds of years, one thing about our country is that we continue to grow in population size, right? Our workforce continues to grow. So what could be different this time that has never happened before is that our workforce really isn't growing anymore. And that is largely due to demographics, right? So people started to have smaller families in the 1980s. And so our workforce doesn't grow anymore. So when we look at a decline in employment numbers or a decline in the rate of growth of employment, that could be demand side driven. Traditionally, like was mentioned in the past, so the economy is slowing down, so there's less demand for labor. But there are also supply side aspects we have to think about as well. I mean, what is the appropriate monthly job growth number for a country like the US that's not really growing that much in terms of workforce? So I don't really view it as concerning that we have downward revisions, because obviously we can't continue to grow our labor force indefinitely. We simply will run out of people. And so I think we have to think about the supply side of labor as well, especially now as the boomers continue to retire, our labor force could be shrinking, depending on immigration, of course.
Yeah, I was going to throw in there that immigration's been a nice fill-up lately. FILIP. Anyways, go ahead, Michael.
That's good. Let me just reset the room for the remaining minutes. Everybody, please make sure you follow Danielle DiMartino Booth, Joseph Wang as well here on X. But if you want to come up and ask questions, click that bottom left mic request button. And as always, this will be in podcasts under Lead Lag Live on Apple, Spotify, and YouTube. Okay, so Joseph, I want to push back on your pushback around the idea that markets are a discounting mechanism and that there's a signal effect and doesn't necessarily impact the economy in the way that one might think. I don't necessarily disagree, but I think there's some nuances there. I think that's a good transition to talking about regional banks, because the regional bank ETF, KRE, has had a pretty nasty drop just the last several days. It doesn't look like it wants to kind of get any kind of real momentum. Could be noise, could be something, could be nothing. I'm curious just to hear your take on where are we with the regional bank crisis that everybody forgot about because of NVIDIA.
So if you look at what I was tweeting back then, I was telling everyone there was no regional bank crisis. And if you were thinking that there'd be because of some kind of blow up that would compel the Fed to cut rates, you would be totally wrong. And I think that is exactly how it played out. I don't believe there ever was a regional bank crisis. The way that I look at this was that we had the Fed hike rates, a lot of speculative tech went bust, and we had a few banks that built their business model around these speculative techs go bust with them. And so that's the crypto banks like, Silvergate, and that's Silicon Valley with their VC stuff, and First Republic, also San Francisco-based bank, and so forth. So what I've learned over the past few months is that there's tremendous ignorance as to how a commercial bank works, especially post GFC when everyone is under Basel III. So if you're thinking that we would have some kind of crisis, some kind of financial meltdown, that was never the cards. And, that doesn't mean that these are great buys. We have a lot of new regulation coming that's basically going to crimp the earnings of these banks. But I don't think there's going to be any disaster. It's probably just, unfortunately for them, they're just not going to make as much money as they used to.
So I would simply guide everybody to a Wall Street Journal story that was out yesterday. It's rare that you see any financial media writer use the word doom loop in a title, but it did give an interesting in-depth prison on smaller regional banks, high concentration, which is something the former Boston Fed President Eric Rosengren was very in tune with. I highly admired him. It's simply the concentrated level of commercial real estate on some of these smaller banks. I agree with Joseph's views on the structure of the banking system, but I don't think that the collateral and the loan concentration at regional banks is a story that has yet to fully play out at all.
So to Danielle's point, the Fed does a semi-annual financial stability report. In their most recent one, they did a survey of commercial bank exposure to downtown retail and office space, which, as we all know, is the sector of commercial real estate that's the most vulnerable. Now, commercial real estate is a broad asset class. You have hospitals, you have retail, you have multifamily. Among those, the most vulnerable are these downtown office space and retail spaces. So according to that financial stability report, big banks, GSIBs, had minimal exposure. Big regional banks had minimal exposure. But the thousands of small banks that we've never heard of have sizable amounts of exposure. I think in aggregate about 500 billion. To Danielle's point, now that could be a problem. Now, I think the question to whether or not this is severe is two parts. One is how well is it distributed? Now, commentary that I've heard from press conferences and Fed speeches suggests that it's pretty widely distributed among the thousands of small banks that we've never heard of. So, I think that makes it less likely that there will be any one point of weakness. And also, we want to think about, just what is the future of this asset class. So we're reading right now in the news, we have a lot of big companies trying to pull their workforce back into the offices. Maybe that continues. And if so, maybe this downtown commercial real estate problem just kind of goes away.
I'm gonna put a huge no comment out there.
What's set at least for a good conversation is to have differing thoughts on this. And Emily, I'm with you on that. I mean, in March, because I was very loud in public saying I think it's a melt up year, but there's a credit event at some point in the year as a pre-election year kind of plays out. And I had people tweeting at me back in March saying, "Oh, this is your credit event." I said, "I don't think this is it. If there's going to be something that breaks things, it has to be something that central banks cannot fully control or get ahead of, right, as easily. And, even if that did metastasize in something bigger, there's a playbook because we went through 08. But let's do some scenario analysis on what could be sources of tail events. So you mentioned, we touched on Japan a little bit earlier. I had this whole thesis out there that I think that there could be a reverse carry trade dynamic because at some point, weaker yen with surging oil against a population that is very used to deflation becomes really problematic for the Bank of Japan, and they're going to have to step in to try to defend the yen. And how do they do that? By tightening monetary policy, even just a little bit. That could have all kinds of ripple effects. But since we talked about the dollar and now we're talking about international, Joseph, I'm curious your thoughts on how do global financial responses to inflation, how do those maybe become bigger problems for the Fed if something does happen overseas?
Well, I mean, if you have a financial accident overseas, that would be a deflationary push, right? So I don't know if that's going to happen. In my view, if you want to think about tail risk, what I think about as the most likely tail risk is some kind of disruption in the Treasury market. So this is something that I've been talking about for over a year, but I think there's real risk that you could have the Treasury market melt down in the same way that the UK gilt market melt down. And this is going to be a particularly big problem because US Treasuries are just, a global benchmark, right? So it's going to pull global yields throughout the world higher, and it's going to cause a lot of capital losses that could also have solvency concerns as well. That being said, this is also something that would be met with a very swift policy response, depending on how the Fed is thinking about this. I mean, you could come in and you could do some kind of stabilizing purchases like the Bank of England did in the fourth quarter of last year. So I think it would be a dip to be bought if that were to happen.
Yeah, I had put out that post 5 days ago as I was seeing the Treasury side again telling off saying Treasuries are the credit event. And so I'm aligned with you on that. I think at some point that even more than just central banks probably cutting, that would probably spark a flight to safety trade back into Treasuries, right? It becomes the source of the pain. And then at some point, it filters through to all risk on assets. I'm blown away that people think that you can have Treasuries collapsing, but equities holding. That to me makes absolutely no sense. I mean, the entire system is predicated on the risk-free rate. If that has more risks than anything else, I think everything's in much more trouble. But Danielle, I don't know if you want to add some thoughts to that.
No, I think you guys covered it really well. The only thing I would add is that in addition to the Bank of Japan, we should be paying attention to how difficult the task is becoming for the People's Bank of China, really to hold the dollar peg as well. In other words, there's not just one ancillary source of potential strain in the global financial system. Of course, we could never quantify what it might be coming from China. But nonetheless, I think it's something that we have to pay attention to. We've actually gotten lots of pushback, but we've been bullish on the dollar for all of 2023. And a lot of it has to do with what Richard Fisher, my boss, used to say, that the United States was the most attractive looking horse in the glue factory.
I think that when we think about China and more broadly and going forward, I think we also have to have more of a geopolitical lens when we look at things, because that there seems to be some kind of economic warfare going on. Let's look at the oil market, for example. So when inflation was high and when there was a war in the Ukraine, so the Biden administration was releasing lots of oil to try to tamp down on revenues for Russia and inflation, right? And then we had the Middle Eastern OPEC powers step in and do the opposite by voluntary production cuts. And of course, we have ongoing economic war with China. We have the US putting all sorts of restrictions on exports and so forth. It's very overt. And you have China retaliating as well. So I saw a line that China doesn't want its state employees using iPhones anymore. Now, from their perspective, I mean, one of the tools that they have to think about as well is their tremendous exposure to US treasuries. Now, what if they wanted to shift that a little bit, maybe to other currencies or other types of assets? Now, that's going to have implications. And of course, they are very aware of what happened to Russia's exposure to treasuries during last year as well. So I think we have to keep that in mind in looking at market actions, because there could be a lot of these geopolitical things going on that are outside of our traditional fundamental models.
I see a few people wanting to ask questions, but just make sure you follow me, those that are prompting, and then check your DMs so I can bring you in here. We haven't talked about Europe at all. Germany seems to be economically not in the best of places, although the markets are not really responding yet in a very aggressive way. Any thoughts on the Eurozone, the ECB, and how inflation there could have all kinds of other ripple effects on what the Fed does next, Danielle?
So, I'm kind of dumbfounded that the world's third largest exporting nation, which is kind of it's a prism, a very clean prism, if you will, into the Chinese fundamental economy. But I'm kind of intrigued that, we got really ugly industrial production data out. Obviously, factory orders were just awful. But I'm intrigued that nobody cares that there's been 3 quarters in a row of contraction in the world's third largest exporting nation, and what the potential drag could be from deflationary forces. I think Christine Lagarde's going to be really caught out. I mean, badly caught out, because she wants to look like she's independent and independent in her thought process. But I think that the data are telling her that she's going to have a much bigger recession problem on her hands than she does an inflation problem. So as much as we like to bandy about the word stagflation, I think Christine Lagarde is playing with fire right now. And we're also, by the way, seeing France, the second largest economy in Europe, slow down very much, when you're looking inside of the backlogs of their manufacturing sector, their services sector. These are numbers we have not seen again since 2008, 2009, 2010.
Yeah, and to add on to that, I mean, that's kind of one thing that's different between over there and here as well is that here we have fiscal policy that continues to be very stimulative, as we all see in the charts. Deficit spending continues to be, let's say 7% of GDP, which is very high. You don't really see that at times when the economy is doing well. You don't really see that happening in the Eurozone as well. So you can so this goes back to what we talked about earlier, where going forward, the ECB is probably going to have to cut rates sooner than the Fed, simply because it seems to be working much better. Like the data Danielle cited, their inflation problem is probably going to go away much sooner than we see happening here. Or here, in addition to all the structural things we talked about, we also have fiscal stimulus that makes the economy continue to perform, I think, above most people's expectations.
Any hope for that fiscal spending to ever go down, Danielle? I mean, I put a post out on the lead lag report itself. It's actually pretty amazing. There's a lot of money that's been put out by the government, even pre-COVID. You look at the last 5 years, CPI total inflation matches a typical 60-40 portfolio, meaning a moderate allocation type of portfolio, 60-40. It pretty much equals the rate of inflation. So in real terms, we haven't made much progress. And obviously a lot of that's because of the bond market side. And that inflation is probably partly because of an Inflation Reduction Act, or at least that kind of thinking.
Well, so there's the employee retention credit, and I'm not going to spend the next 14 minutes talking about it, but let's just say that my favorite guy, my biggest man crush right now is on the commissioner of the IRS, who's got an amazing resume, and he really is clamping down with due deference to Mr. O'Leary on the Employee Retention Act. We went from 30 billion to 13 point something billion from July to August in terms of lining the pockets of wealthy people with this highly fraudulent program. So that's refreshing. To your point, though, I think we are going to see, whether you're talking about rail data, freight data, manufacturing data, construction data. You are seeing 18 months later, the infrastructure spending manifest in current economic data. And you're seeing going forward, you're seeing companies like Ford Motor take $9.8 billion of a loan to build an electric vehicle factory that's going to lose money. So you are seeing signs of this. The fact that, and a huge shout out to dailyjobcuts.com because they're listening and I've been following them for years and years now. The fact that we have 9 companies closing per day, they track closures and they track layoffs. And that's north of the 6 in May, June, and July. The fact that we have 9 companies closed every day in the month of August, amidst trailing 12 months of 9% deficit spending coming out of Uncle Sam, that means the real economy is slowing way more than we can see with the naked eye because of this massive offset. Again, Daily Job Cuts, it's been in business since 2009. Thank you. And right now we're seeing closings persist at a faster rate, which of course, if you work for yourself, you're not going to go file an unemployment claim. You're not going to claim unemployment insurance against yourself. Not what we're seeing in the data, but it's definitely what we're seeing on the ground. So Michael, I don't think we get another fiscal burst. And I think that the Freedom Caucus has so much egg on its face that it's not going to approve any kind of stimulus type of spending that directly deposits money into people's accounts unless we see a blue wave on election day. And then we might see something in the first or second quarter of 2025.
Joe, I don't know if you want to add some thoughts to that, but I do think it's, the reality is the way people vote based on nominal, right? They don't vote based on real, which is, I think, largely why you continuously have more and more government spending. But the effect on people's portfolios on a real after inflation adjusted basis being caused by a lot of fiscal spending, I think is just broadly underappreciated.
I would step back and just look at the political culture more broadly. I remember, just 10, 20 years ago, we had a lot of people who took this balanced budget stuff really seriously. In fact, I think in the 1990s, we actually had a budget surplus, and the Treasury, just trying to be good stewards of the public, actually went and bought back some higher yielding Treasury debt, hoping to save the taxpayer some interest expense. Now, I don't think that's happening today. I don't think it's going to happen anymore. The way that politicians get elected today on both sides of the aisle is to promise more benefits. It can be benefits to the broader public in terms of, say, education, childcare or something, or it could be tax cuts and, I'd say, government contracts. But I think there's this big cultural shift such that, regardless of who's in the White House, and there are some people, as Danielle rightly mentioned, who are against this, but I think they're fighting a losing battle. I think the broader political shift for the coming years is just be spending more money.
The one thing that we can pretty much say is guaranteed in this business, when you should never say guaranteed, like the one thing that you can say is guaranteed is continued government spending. Danielle, maybe for the last few minutes here, anything that you think that people listening to this space, to this podcast, things that they should be focusing on that are not getting that much play in the media that you think could be a bigger deal going forward?
So I think my one message, and what I said to you was that I was concerned about the quote unquote anger element that I've been seeing of late. And I really am. I think, especially because so many people listening right now are extremely active on social media. I think that what we should all be attuned to is actual data. And right now, we just mapped out for tomorrow's daily, we just mapped out inflation in 7 different ways, 7 different indicators, and 7 different indicators are going down. So and yet, if you mention that in the public purview, in the social media space, you get a lot of anger. And yeah, I could be talking about .com stocks in 1999 had Twitter been in existence then. But my point is, whenever you put plain old data out there and you get an angry retort on social media, and I'm being really polite in saying and using that word, then you should always be concerned that you always be concerned when the data is dismissed and somebody's coming at anything with an agenda, especially when there's an anger element involved. And again, I have not seen this to this degree since 1999.
I will say I see that almost all the time on my feed. I've used that line many times before. You're right when the counter argument is an insult, which, anger is one way to get there. Same question for you, Joseph.
I think something that I think about is, so when I look at markets and the economy, you have to keep in mind, this is not physics. The rules are made by people and they can change the rules. One thing that I've been hearing a lot by prominent people is that there seems to be, not just in the US, but globally, some more of a push to have a higher inflation target. Now, I think this could fundamentally change basically all market pricing, right? So if you want to shift an inflation target higher, that's going to affect the bond market, which of course affects the equity market and all the risk assets and everything that's built on rates. If you are someone who's buying a 30-year Treasury, you have to keep that in mind, right? So maybe within 30 years, which is a long time, maybe the inflation target does go up. After all, sooner or later, we're going to get to a point where the government, the public policymakers are going to have to decide between trading off between inflation and employment. And I think the political cost is such that maybe people are not willing to accept higher job loss. They'd rather keep their job than have, and if that means higher inflation, then so be it. So there's this huge shift, I think, that's happening under place. And I think that eventually that will happen. And if you have any longer dated investments, that's something that you have to keep in mind.
Danielle, for those who want to track more of your work, where do you point them to?
I'm on Substack, DiMartinoBooth.substack.com. And of course, on Twitter at DiMartinoBooth. And then there's my private Twitter feed at DDMBPro for my institutional investors. Michael, do I have like 60 seconds to add something as a parting thought?
Absolutely.
So my buddy George Goncalves was on a little bit earlier. If you don't follow him, follow the bond strategist. He's amazing. But he and I had been going back and forth talking about the National Bureau of Economic Research dating the 2-month recession that ended in April of 2020. Well, on April the 15th of 2020, the CARES Act directly deposited zillions of dollars into U.S. bank accounts and thereby bypassing the transmission mechanism of monetary policy. This is my point. If you push back on the NBER dating the recession as being a 2-month flash recession that was in the spring of 2020, and you instead say, well, of course, inflation adjusted personal consumption expenditures increased in mid-April of 2020 because people got zillions of dollars directly from the government. If you take that stance, and I just want you to carry this into the weekend as a deep thought, we're in the 171st month of an expansion right now, which blows away the 120-month prior record. And I've seen so much macroeconomic analysis of late that says, gee, this is reminiscent of late 2019. Gee, this is reminiscent. Everything's like back to 2019. What if we never exited expansion and we're just in the longest, most protracted, most perverted, most corrupted monetary policy, fiscal policy, U.S. economic expansion in the history of mankind?
That would get a lot of people angry. I think going back to your point, and by the way, an offshoot of that is something that I keep myself saying publicly, which sounds crazy when I say unpopular opinion, the bear market's not over. That this is probably more the greatest bear market rally in history. I could be totally wrong on that, but you never know how this stuff plays out. Joseph, any kind of last thoughts? And again, where can people find your work as well?
First off, thanks so much for tuning in. It's a pleasure to be here talking with Michael and Danielle. Great follows, learn a lot from you guys. And if you're interested in hearing more about my work, you can check out my website at www.fedguy.com. If you're interested in learning about the financial system, you can also check out my book, centralbanking101.com, on Amazon, a top seller in the category. One interesting thing I would actually leave everyone is that, in order to have growth, you need to have more inputs, right? That can be more people working, or you can get more out of the same inputs. So productivity, more technology. Now, in the future, if our population is really not growing, if it's maybe even shrinking eventually, like many other countries, we can have a world where we actually don't grow. We actually, on the aggregate, have perpetual recession, but perhaps we grow on a per capita basis and we're not any worse off.
Lots of deep thoughts, Michael. Lots of deep thoughts. This has been a lot of fun. I really appreciate you having the both of us on. And 2 former Fed insiders. What are the odds?
No, and I appreciate you having a change of your schedule a little bit for this. Again, folks, this will be a podcast under Lead Lag Live. Hopefully I'll get it up in a day or two. And hopefully I will see you all on the next space tomorrow. Thank you, Danielle. Thank you, Joseph.